Today, we are joined by Dr. Robert Kunnen, who is a frequent professor at HASP. Bob got his master's degree in economics from Western Michigan and went on to get a PhD in economics as well at the University of California, San Diego. He then became the dean of the business program at Davenport University for many years. And then in 1986, he moved on to be an economist for the Principal Insurance Company in Des Moines, Iowa, and then AIG. And then his last opportunity as an economist and financial planner and analyst was with American Equity, also in Des Moines, Iowa. So without further ado, Bob Kunnen.
Thank you. Thank you. Thank you very much. I wasn't exactly sure how people were going to respond to a class on Warren Buffett, but I think he's one of the more intriguing characters that's been in the investment management business over the last 50 or 60 years. What a lot of people don't recognize is that most of his wealth was accumulated after he was 50 years of age. And he also gave away about 30 or 40 billion dollars to philanthropic organizations over that period of time when he had his firm, Berkshire Hathaway. He's an amazing individual, and I think somebody we can all be very proud of. I want to tell you an interesting little story. He was playing golf at Pebble Beach one day, and somebody said to him, "Warren, if you make a hole in one today, we'll give you $10,000. But if you don't get one, you need to give us $10. And he said, "I'm not going to take that bet." He said, you have to know what your standards are. And he said, "I'm just not willing to take that chance." And I just thought to myself, that's kind of an interesting response. You're gonna potentially lose $10, but you could get 10,000. And but that's just the kind of character he was, and I think he's just a very fascinating individual. One of the interesting things is that if you look at his career over the last 40 or 50 years, the stock price of Berkshire Hathaway has increased by 1,000,000% from 1964 to 2015. The S&P during a similar period increased by 2,500%. Think about the difference. If you had invested, $1 million with him in, 1964 or something like that, it would be worth an amazing sum at this point in time. I wish I had been that smart to invest it in that company, because he's done an amazing job with that portfolio, to say the least. A couple of interesting quotes. If you go into the Berkshire annual report every year, it's full of interesting quotes that he's put in there. And I found that when you read that, you can learn a whole lot about his investment philosophy in that. It's worth taking the time to do that. For instance, a couple of them, he said, if you can't tell whose side someone is on, they're not on yours. I thought, well, that's an interesting comment. Another one is managers that always promise to make the numbers will at some point be tempted to make up the numbers. I've seen some of that over the years. One of the fascinating things about him is he still clips coupons. This is a guy that's worth $80 billion, and he's clipping coupons every month to save on things that he's buying. I didn't realize that anyone was even doing that anymore, but he is. Anyway, he's a very interesting character, and I want to tell you a little bit about his investment philosophy. He's still very active in the market, as you might expect, and see if I can find my thing here. Here's some interesting facts about him. He's the fourth richest person in the world, but does not want to be evaluated on this basis. He never talks about what his net worth is. As much as we can tell, it's probably something worth in the neighborhood, in the area of 70 or $80 billion. but he's already given away 70 or $80 billion to various philanthropic organizations around the country. It's pretty impressive to say the least. He never spends more than $3.17 on his McDonald's breakfast. Every morning he goes to McDonald's and has breakfast. It's kind of interesting as somebody that has that kind of wealth, and he's at McDonald's. He started picking stocks at 11. Coke was his first. That was a very smart move on his part to invest in Coke at that point in time. He's very much of a philanthropist. He involved in numerous charities. At 10, he had lunch with a member of the New York Stock Exchange to exchange ideas. Think about that. 10 years old, and he's exchanging ideas with the head of the New York Stock Exchange. It's pretty impressive. At 12, he was making $175 a week on stock investments. I don't know about you, but at 12 years of age, I was looking for golf balls, and I had no idea what I was doing. Charlie Munger, who was his partner, played a pivotal role in his investment philosophy. He's given $60 billion in contributions. He's the all-time leader in the U.S. in terms of contributions to various philanthropic organizations. That's pretty impressive. He amassed $53,000 by the age of 16. I was trying to think of how much money I had in the bank at 16 years of age. I'm not even sure I had a bank account at that point, but he was trading stocks from 13, 14, 15, 16 years of age. He was initially rejected by Harvard University, couldn't get in. I often wonder what Harvard thought when they seen how his career developed over that period of time, and they may have lost some of those contributions that he was making to various organizations. He was originally rejected by Benjamin Graham, the acknowledged first leader of modern investing. Graham finally came around and recognized his potential and got him involved in the business, and he really took off after that. He spent $100 to take a Dale Carnegie course at age 16. He plays bridge 12 hours a week. He drinks Coke all the time. He has 12 glasses a day. I'm not sure that's the healthiest thing in the world to have 12 glasses of Coke every day. 99% of his wealth was earned after age 50. He has the longest track record for beating the market, 40 years in a row. He outperformed the market. That's pretty impressive, to say the least. $1,000 invested with him in 1964 would be worth $19 million today. Think about that. If we had been smart enough to have invested in Berkshire Hathaway stock at that point, you would have been well set for the rest of your life, to say the least. People are so fascinated with him that they will spend millions to have lunch with him. I put 5 million on there for the last one. It actually was 19 million because whoever bid the 5 million decided to throw another 14 in. So it was $19 million that was contributed to charity to have lunch with him. That's kind of amazing, to say the least. He measures success by how many people love him. I'm actually wondering how in the world he knows that. That's an interesting issue. He still lives in the original house he purchased in 1959, and he said it's the best investment he ever made. He's never moved since 1959, which is pretty amazing, to say the least. So here's the Buffett approach to investing. There are 11 principles that he pursues. The first one is never follow the day-to-day fluctuations in the market. He doesn't even look at what's going on in the market on a daily basis. He picks stocks that he's comfortable with and he invests in them, but he doesn't look at what they're doing every day. Don't try to analyze the general economy. There's too many variables. How can you predict the economy? I think this is a really important point. When you watch the nightly news programs and things of that nature, Everybody's predicting where the economy is going. He would say that's nonsense. Your chances of predicting what's going to happen in the economy are almost non-existent. And it's not the way you should be investing. You ought to pick companies, not individual stocks. Look at companies and invest on that basis. Buy a business and not a stock. Understandable, consistent operating strategy, the probability of long-term prospects. And he's done that with everything he's invested in. If you look at his portfolio, the portfolio of Berkshire Hathaway today, that's exactly the way they invest. You pick a company, they like the business, they like the company, the integrity of the management and so forth, and that's how they pick stocks. Manage a portfolio of business. Is the management rational? Stock declines are a great way to add to positions. Hold stocks for the long term. Some of the stocks that they have in their portfolio have been in there for more than 40 years. I cannot tell you how important that is. When you invest in stocks, you don't do it for a 6-month period or a year period or whatever. You invest over the longer term, and you don't worry about the day-to-day fluctuations of what those stocks are doing. Do not engage in day trading. He would say that that's a fool's game to try to guess where the market is going and so forth. And I'm sure you all have seen that. You invest in a stock, the next thing you know, it goes down a couple of points or something of that nature. You think, boy, what a fool am I? He would say, don't worry about that. If you're comfortable with that stock, you invested in that over a longer period of time, you're going to do just fine. And he said, look at cash flow and return on equity. Those two things are the most important criteria, not on earnings per share. He would argue that earnings per share is too volatile. There's too much movement in that. You know, you can have a company that in a given quarter decides to take a big write-off, and they're going to report not so good numbers and so forth. He would say, well, look at that company over a longer period of time, see what their cash flow is, see what their earnings are and so forth, and make a decision based on that. The other thing is that he would say that you know, you're looking at cash flow and return on equity. You can get this information very easily online. What is the value of the business? Invest within your circle of competence. You know, today everybody is talking about artificial intelligence. You can't pick up the Wall Street Journal or anything else without seeing stories about that. I would ask the question is, how much do people know about artificial intelligence and the companies who are in that business? And I would argue that a lot of people have no clue what companies make sense and what don't. There are so many startups right now in AI that I don't know how you make a determination as to which of those companies are going to survive going forward. So that's something I would say you got to be a little bit careful with today until you see how this stuff emerges. So here are some other important things. Can a company be purchased at a discount to value? And what he means by that is if you look at their financials and things of that nature, is the stock undervalued relative to what they're producing? It's very easy to get that information out of their financial reports. And I'm not sure there are a lot of people that do that. Everybody tends to follow the crowd. I don't think that's the proper way to make an investment. Look for companies with high margins and good management. Management integrity, are they trustworthy? He actually spent a lot of time talking about management integrity and whether or not you can trust what companies are saying and so forth. And he at one point said that more than 50% of the companies exaggerate the quality of their business and what they're doing and so forth. I actually think that number is too low. When I look at annual reports and things of that nature, everybody is talking about how great the business is and so forth. You got to dig deeper than that to be able to see what's really going on. You need to do your homework always, always. And I'm not sure that everybody does that, where they'll look through the annual reports, they'll read the letters that are being written to stockholders and so forth. They don't take the time to call the companies and talk with them about what they're doing and so forth. I know that when I invest in stocks and that, one of the first things that I do is to call the company, and I'll talk with various people within the organization to see how things are really going and so forth. It's amazing what you can find out when you take the time to do that. And you're going to get information that you may not be able to discern if you're looking at just their annual report or their letter to shareholders and things of that nature. And one of the things I've found is that when you get somebody on the phone from their financial department and that, it's amazing what they'll tell you that they don't say to everyone if you start asking these questions and so forth. And it's a good way to find out what is really going on within the company. Use online analytics. It is amazing how much information is out there that you can get access to. If you look at the online analytics of the company, you type in the ticker of the company, you'll see hundreds of stories about what's going on with this company and so forth. And it really is useful to kind of look through these reports and see what is actually going on. Some quotes from Buffett. I love these quotes from him. One of them is, an investment requires safety of principle and a satisfactory return. Remember this always. If you don't find a way to make money while you sleep, you will work until you die. I think that's very valid, to say the least. The best investment you can make is in yourself. The more you learn, the more you will profit from it. Another one, we don't have to be smarter than the rest, just more disciplined. A lot of investors are not very disciplined when they make investments, and he would argue that they need to do a lot more research on these companies before they invest in them. And do not save what is left after spending, but spend what is left after saving. Boy, that's a good thing to share with people. Not everybody pursues that, to say the least. Be fearful when markets get greedy, but greedy when markets are fearful. The point on that right now is that the market is way overvalued. Almost all the analysts would agree on that. I agree with that as well. This is a market situation where you got to be a little cautious about what's going on. When everybody's piling onto stocks and so forth, that's a time to think about maybe pulling back a little bit. And I think it's pretty obvious when you look at the metrics in the stock market today that whether you're looking at PE ratios or other kinds of things, people have gotten too optimistic about the earnings that are going to be generated by these companies going forward. So look for three things in people: energy and integrity and intelligence. If integrity is not present, walk away. You know, I'm sure a lot of you know that you've been involved in business and things of that nature. You can tell very quickly whether you're dealing with people that are honest and so forth. And if you've got people working for you who don't have integrity, you got real problems on your hands. And I've seen that over my business career, that sometimes these people can do a lot of damage to a business if they're not truthful, they're not pursuing strategies that are appropriate and so forth. Just a good thing to be aware of. If you cannot control your emotions, you will not control your money. I think that's really important. It's too easy to get caught up. When you ever see everybody throwing money into the market, your reaction is, I'm going to do the same thing. That may not be the best response, to say the least. The stock market is designed to transfer money from the active to the patient. You know, I think that's really true. you invest over the long term. And Warren Buffett was a perfect example of that. When you look at the number of stocks in Berkshire Hathaway, some of those stocks he's owned for 40 or 50 years. And he's never sold them. They continue to be great uh, companies in terms of returns and so forth. And I do believe that that makes a lot of difference in terms of what your ultimate return is if you're willing to hang on to these things for a long period of time. Think of a house, for instance. If you buy a house and you hold it for a year or two, there's a high probability you're going to lose money. On the other hand, if you own it for 10 or 15 or 20 years, there's a high probability you're going to make money on it. Same thing is true with stocks. And that's a point that he used to make on a relatively active basis is you invest for the long term, not just what's going to happen over the next year or two. Money is not everything. Make sure you earn a lot before speaking such nonsense. You know, when people make that comment to me that money doesn't count for anything, my reaction is, are you kidding me? Um, everything you want to do, you want to travel, you want to buy a house, you want to buy a new car, or things of that nature. It's a function of how much money you have available. So when somebody says money is not important, my reaction is, what have you been drinking? Um, I just don't understand that logic. It takes 20 years to build a reputation and 5 minutes to ruin it. How many times have you seen this over the years that somebody you're working with or whatever, they get in trouble? And the next thing you know, their reputation is shot and it affects their business career, their relationships with other people and so forth. And I'm often amazed by people that don't take more time to take that into consideration. And this comment about Charlie Munger, I think is very interesting. If you go back and review their relationship back when they first started doing business together, the impact that Charlie Munger had on him was nothing short of amazing. I'm not sure Warren Buffett would have gotten to where he is without that relationship with Charlie Munger. He was an amazing individual, and yet you don't hear as much about him as you do Warren Buffett. It's worth looking into him and what he was able to accomplish. So the question comes up about sources of data. There's all kinds of ways of getting information on companies. I'm quite amazed that people don't read their annual reports more often. It's not unusual for the CEO to send out a letter describing what's been going on in the business and so forth to shareholders. And when I ask people, did you read the most recent letter from the CEO? Very few people answer yes. And I don't understand that because it's amazing how much information is included in those annual letters that go out to shareholders in that. Now, they may look at the annual report, the one that's sent out to all shareholders and so forth, but it's really important to read the annual letter that comes from the CEO describing on what's going on in the business and that. A lot of times you'll pick up information that you will not necessarily see in the annual report, and it's worth looking at that, to say the least. The internet. If you type in the ticker for a company, you will be surprised at how much information is out there. Now, some of it's irrelevant, and I understand that not all of that information is valid, but a lot of it is. And it's worth doing that on a regular basis just to see what's going on and what people are saying about the company and so forth. I would encourage you, if you have stocks and things of that nature, take the time to do that. It's surprising what you'll find in there. Research from brokerage firms and so forth. Sometimes I'm a little skeptical about these. You never know what you're going to say or what what their objective is, whether there are other things that they're getting from working for this company, but it's worth at least looking at that as to what they're producing in terms of research information and so forth. Something I really like to do is to talk to the company reps. It's not uncommon that I'll call somebody in the research department, the finance department at a particular company, and just start questioning them. It's amazing what they'll tell you that they may not be willing to put in words. A lot of times they don't hear from anyone. And so when they get a call from somebody, a shareholder or something like that, who's asking them questions, you'd be surprised at what they'll tell you about what's really going on in the company and so forth. And I do that all the time. And once I have their name, I'll call them every quarter just to see what's going on. And I think they appreciate the fact that somebody's actually interested in what's happening in the company and so forth. The Wall Street Journal, I debated about putting this in there. I never know how accurate some of that information is that's being generated by these individuals who are writing these articles and so forth. But I think it's interesting to take a look at that, see the stories that are written about some of these companies and so forth, and decide whether or not there's more research you should do. Quite often, if you look in various sections, you'll see that they'll do a story on a particular company and try to explain to you what's going on and so forth. It's worth looking at that. What I like to do is based on that, if they put some names in there, I call the company and I actually talk to the person. They don't always expect that, but it is surprising how much information you can pick up when you take the time to do that and so forth. And it's just basic research. And if you're going to put a lot of money into a company, that's the kind of information you really need to have to make a good decision going forward. I skipped over a slide here. Uh-oh. I lost it. Anyway, so Warren Buffett I'm sorry. What did I do wrong there? All right, don't worry about it. So I was going to tell you that Warren Buffett just turned 95. He's still working 8 hours a day, looking at investments and so forth. And he's still very active in Berkshire Hathaway and so forth. And I think it's kind of amazing that he has never lost his interest in looking at stock investments and so forth. And he still advises the company on a regular basis, even though he's no longer chair of the company and so forth. And I'm told by some individuals I know at Berkshire that he regularly meets with the investment staff to share his ideas on companies and so forth. And would that I am that active at 95 years of age and have the ability to do something like that, but he loves every minute of it. He reads for 6 hours every day on different companies and so forth. Um, I can't remember the last time that I read something for 6 hours. But he is still very active in that regard and so forth. And I think as long as he's around and providing that kind of information to the company and that, Berkshire Hathaway is probably not a bad company to take a look at. Um, Being able to maintain that level of interest over a 50 or 60-year career is pretty impressive to say the least. So I kind of left this, talk to the company reps. I'm sorry, go ahead.
When you were talking about research, I really appreciate your activism, but some of us are not that brave or don't even know who we would call. What do you think about outfits like Morningstar? I've done a lot of research through them, and they kind of digest a lot of the information
Right.
and kind of give you the report in a method that at least I can start to understand.
Right. You know, it's surprising when you take the time to call the company and you ask them to connect you to the accounting department. And you say, I have some questions related to the company. Can you put me in touch with the research area? The people you can get access to. I've actually had some success over the years of saying, I'd like to talk to the CEO of a company. Now, sometimes they'll say to you, you know what, this person has more important things to do than talking to a shareholder, but I've been amazed at the number of times that they put me through. And in cases where I didn't get to them initially, they would return the call. I just think it's worth putting your foot forward and start asking questions of these people and so forth. And you'll be surprised at what they'll tell you. Sometimes the information you'll get may be different than what's being published in the annual reports and so forth. Once you get to know some of these people, they'll share things with you that you'll never see in the annual report. And if you're going to put a lot of money into a company, it makes sense to ask questions. A lot of you probably have some pretty good sized stock portfolios and things of that nature. You deserve to get answers about the company and what their future prospects are. What are they doing in terms of new product development? Are there issues that are likely to surface in the next couple of years that might be problematic or whatever? And as I said earlier, when you're talking to an individual, a lot of times you can get information that you're never going to see written up. And I do that all the time, you know, and I have the names written down. So I just call them back and I say, you know, this is Bob. And what's going on? And it's useful to do that kind of research. I mean, if you have a relatively large position in a company, at the very least, you should be doing that on a regular basis. Yes.
Hi. Okay, you can come up and you can go in and say, hi, I'm Bob. But if I go in and say, hi, I'm Linda Walbert and I live in Holland, Michigan, and I just inherited my grandmother's $100,000 and I wonder if you can tell me blah, 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 but you're going to be finishing your conversation in a very short period of time.
You know,
I mean, it is going to matter if they think that they're talking to someone. You're investing for other clients. You can say, I'm out here in Des Moines. I've got 100 clients who are interested in your company and we have some questions, and you're going to get to somebody.
you know, all I can say is that a lot of,
But I do understand what you're saying. And I agree with your fact that American companies are maybe overall more willing to tell you more truth about their companies than maybe in some other markets or other countries or so forth. We have a tradition of, we want to know the truth.
You know, again,
Or even if you're questioning something that was in the annual report.
you know, sometimes I'll ask questions about the annual report and that, but a lot of times I'll ask questions about what I've seen in financial statements and so forth.
Yeah.
I'll ask them about the nature of the business, you know, what's going on in terms of product sales and so forth. You know, what is their strategy over the next couple of years in terms of expanding the business? And you'd be amazed at how much information you can pick up. Some of these people don't hear from anyone.
Well, and I'm sure that they train quite a number of people who are going to be available to talk to people on the phone who really know a lot of answers to questions, and that's
Yeah.
their business to talk to their shareholders.
You know, and I'm sure a lot of you recognize when you were working for various companies and that, you very seldom heard from people on the outside. And I found that even when I'm talking with some of their accounting people and so forth, occasionally people will say to me, well, I never hear from anyone. And I said, well, guess what? You're going to be hearing from me going forward. Again, I think it's a great way to pick up information about what's really going on in some of these companies. You know, the problem is when they do annual reports and things like that, they're going to put their best face forward. They're not going to tell you everything that's going on. And what I found is that when you start talking with individuals within these companies, sometimes you'll find out things that you'll never see in the annual report and so forth. And let's face it, with the kinds of stock investments that we all make, we have a lot of money at risk. The last thing you want to do is to get picked off somewhere down the line. I just think it's a good way to manage your portfolio, and that is to make calls on a regular basis. And most of us are not working anymore. You know, what else are we going to do? We might as well be calling somebody in the company and find out what's going on. You know, you can't be on the golf course all the time.
I did a brief check online about Warren Buffett's attitude toward Bitcoin and other
Yeah.
cybercurrencies. And what his comments have been very negative historically, but he does in fact own some. Your comments on Bitcoin and currency
boy.
in general.
You know, I have reservations about that, and no one has ever given me a satisfactory answer as to why I want to invest in that. When I have a choice of investing in a company that's producing a product or something of that nature, and they've got distributors around the country, representatives of that nature, that to me has always struck me as a better way to make an investment decision. When they come up with something like that, Bitcoin or some of the other cryptocurrency things, you know, I must say I'm probably naive and I need to know more about it, but I just don't trust it. And when I look at what's going on in the last few months, where that thing, some of those things have plummeted and so forth, explain to me what you're really getting. What's behind it? Well, what's behind it is you're hoping that there's enough demand out there of other individuals who are investing in it. What happens if that disappears? You saw the crypto market get pummeled in the last few months when everything was going on and so forth. And I'm just not willing to make that kind of commitment. I may be naive, but I'd rather invest in a company that's producing a product that's being sold, a service that's being produced, something of that nature. And it may be a function of my age that that's always made sense to me.
Can you speak more about the quality of management and how you analyze that? Because I mean, I've been at corporations where boy, we've got lousy management. I've been in a corporation where I thought we had great management and they weren't so good. So is that a one-time look, or is that a look at it over 10 or 20 years and how they retain management, or who's coming and going? How, can you talk more about that?
Boy, that's a difficult situation. If you look at some of the quotes of Warren Buffett over a period of time, he's talked about that, the inconsistency of management. He's actually used the word nags, that there are a lot of nags in some of these companies and so forth, who are not particularly productive and so forth. And that's a hard thing to get a handle on, is about the quality and the consistency of management. When I look at companies around Western Michigan, we've been fortunate that we've had some great companies in Western Michigan. And but there have been some that have been very inconsistent and so forth. I'm not going to mention any names, but I'm sure you're all aware of some of the companies that have done relatively well over the years and so forth. But it's amazing what you can find out when you talk to company reps, you talk to brokers, people in the investment management business who are interfacing with these people on a regular basis as to what the quality of that management is. I think one of the things that's really hard to get a handle on is, what are the future prospects of that business? There are so many changes going on. If you look at technology and so forth, every time you turn around, there's a new technology emerging. And some things that have done really well in the last 10 years are kind of falling by the wayside right now. I just think you have to keep track of and continue to do research on what they're doing and what are they doing in terms of product development and so forth. That's one of the toughest things of all for companies, is to stay ahead, develop new products and so forth. And unfortunately, they're not always very good about releasing that information as to where they're going to be going over the next 5 or 10 years. And but that doesn't mean you shouldn't try to get that information and so forth. And now some people would argue, forget all of that, just invest in a number of companies, and more than likely you'll be fine. Some of the companies will do great, some of them might not perform as well, but at least you're going to be relatively well covered. And for somebody like me who's been involved in the investment management business over the decades, I have to have more information. I want to know what they're doing from a product development standpoint. I want to know how current product sales are going. I want to know something about the management, if they've changed management and so forth, as to whether these people are competent, so forth. So I'm probably going to do a lot more research than normal to get a handle on that. But there are a lot of people that don't have time to do that. So they're better off investing in, a fund that has a number of different companies in it. At least they're going to be covered to some extent. Oh, I'm sorry.
As I'm listening to you and I'm thinking about how I invest, I'm thinking that there's like 3 tiers. You have Buffett, who's going out and buying Geico and Burlington Northern and Nebraska Furniture and that kind of thing. Big companies, giant companies, billions and billions of dollars. You are presumably an active investor buying individual stocks,
Right.
taking the risk, but also the reward from that. I consider myself a passive investor.
Right.
I'm more interested in return of capital rather than return on capital. So I'm investing in index funds and mutual funds and CDs. And I know Buffett doesn't really do that, but Buffett also has a story that he told where he challenged a hedge fund guy to match his return on an S&P 500 index fund. And my understanding is Buffett won hands down over the hedge fund guy. So where does that put us? I mean, are we in a situation where should we be investing in individual stocks? Or are we better off investing in index funds and mutual funds and that sort?
It all depends on your risk tolerance. Interestingly enough, I've had the opportunity to meet Buffett on a couple of occasions. A company that I was connected with in Des Moines, we had him come in and talk to our agents a couple of different times, and he made a comment to me one time that the dividend investing, looking for companies that have solid dividend and so forth, is probably the best strategy you can pursue. So it's fine to invest in an index fund, and there are certainly funds that focus on dividend investing in that. But when I look at, for instance, in the energy sector, in the last 2 or 3 years, you could have purchased a number of energy companies that were paying better than a 10% dividend. Those dividends are now down to about 7 or 8%. And they've done really well and so forth. And he would argue that pursuing that kind of strategy of looking for those areas that have gotten beaten up makes a whole lot of sense and so forth. But make no mistake, his ability to pick out great companies is pretty impressive, to say the least. I don't know of anyone that has been able to beat the market for 40 years in a row consistently, and outperform the market. I shared with you numbers earlier about money invested with them in 1964, what it would be worth in 2015, 2016. That's incredible to have that kind of performance over that period of time. And with that, I was smart enough back in of course, I didn't have any money in 1964. I think I was just starting college at that point, but think about that. The growth of that portfolio from 1964 to 2015 is nothing short of amazing. And which brings up that point that I say this to people all the time. If you're in this for the short term, you're making a big mistake. The best thing you can do is to take advantage of compounding growth. The people that have really done well with Berkshire Hathaway have been in there for a long period of time. And I would argue the same is true if you're investing in individual stocks. You invest in a company, you're willing to hold it for a long period of time, you're going to do just fine. The ones I worry about are the short-term traders who are in and out of the market. And I wonder how much money they really make when they trade stocks that actively and so forth. First of all, it's expensive. You paying commissions and so forth, that's not cheap. And so I'm a strong believer in long-term investing. I don't care whether it's a house, it's a stock, or something else. If you have a relatively long-term horizon, in my opinion, you're going to do well if you make investments. I can think of a number of stocks that I bought over the years. Sometimes I've kicked myself. You know, I'll buy them and they're down 15 or 20%. I think, what are you doing? It's amazing how many of those things have come back and done really well. And I really believe that if you buy a stock and you have a relatively long-term horizon, you're going to do just fine.
Question here. I have an online question from Ron. He's asking, Warren Buffett talks about a metaphor of economic moats and castles. What's that about?
Say again?
Says Buffett talks about a metaphor of economic moats and castles. And what's that about?
Well, that's a good question. I'm not sure I can really answer that. I think he, you know, again, his investment philosophy has always been based on holding things over the long term. And when you look at the amount of trading that goes on within that portfolio, it's very limited. And some of the stocks that he's had in his portfolio have been in there for 40 years. And he just leaves them there. They continue to produce good dividends and so forth. I know he has a relatively big energy exposure. And in the last 2 or 3 years, he's bought a ton of energy producing companies, um, pipeline companies, for instance. If you look at his portfolio, things like EPD, which is a pipeline company, ET Energy Transfer, which is a pipeline company, MPLX, which is an oil company, and the size of the growth of those portfolio holdings in his portfolio has been nothing short of amazing. And many of these companies started out at 12 and 13% dividends. They're down to 8% now. So they've had significant appreciation, and he continues to add to them. So, again, I am a big fan of his investing strategy. You buy them, you hold them for the long term, and unless something radically changes, you just don't sell them. If you look at the turnover in Berkshire's portfolio, it's very limited. Now, he'll add to it based on the cash flow they're generating in that, but he hardly ever sells anything. And to me, that's a smart strategy. Yeah.
Quite a bit of what you talked about has been kind of looking at the internal environment. But for a moment, let's look at the external environment, maybe where the political scientist meets the economist.
Right.
And over the long term, no matter where you might fall on what side of the aisle, what has been, if you see any trends in terms of how well Buffett's done based on the political environment, and to what extent that governs, or we see the results and how they've changed over time, given whoever happens to be in the White House.
You know, I'm gonna share a bias. Trying to predict the direction of the economy, or trying to predict what Congress is going to do in terms of taxation and so forth, is a fool's game. It just doesn't make sense from an investment standpoint. I'm going to be wrong 50 or 60% of the time if I'm going to try to predict what Congress is going to do from a taxation standpoint, or where the economy is headed over the next 2 or 3 years. The only chance I have is to try to predict companies that I think have good growth prospects going forward. If somebody had said to me 4 or 5 years ago, we're going to have an outbreak that's going to have a dramatic impact on the economy, I've said, you're crazy. What are you talking about? What I can do is I can pick companies that I think make sense, whether it's pipeline companies, some of the major oil producers and so forth. If you look at what's going on with pipeline companies over the last 2 or 3 years, whether it's EPD or ET or some of the others, the performance of these companies have been amazing. If you had looked at who was predicting that they ought to invest in these things 3 or 4 years ago, it was very limited. Suddenly now you got everybody in the world that's writing stories about pipeline companies that you want to invest in these. And I think you gotta look at areas that are undervalued. I'm a big proponent of dividend strategy. If you pick companies that have solid dividends, and there's a high probability they're going to be able to pay those dividends going forward, why would I not invest in those? We all are impacted by cash flow. And if you buy companies that have a 6, 7, 8, 9% dividend, you're going to do very well for yourself. I bought a bunch of pipeline companies 2 or 3 years ago that were paying 12 and 13%. They're down to 8% right now. And, but, pipeline, to put a pipeline in today, trying to get regulatory approval is almost impossible. They're incredibly expensive to put in. Well, 4 or 5 years ago, you could buy these things at a very low price. And you think oil is going to disappear, oil and gas? I don't think so. Every time I see something written that we're gonna have these new sources of energy. And it's gonna make pipeline companies and things of that nature not as important. I just start laughing because I just don't see that happening.
There's no question Buffett is an amazing guy, but no one's not without their warts. In the case of Buffett, it's probably Clayton Holmes. Predatory lender, and it's been investigated numerous times, but there's no company on the planet that doesn't have some wart out there somewhere. So he still qualifies as the oracle. One of my concerns with Berkshire, and I own the B shares,
Right.
is that, as the gentleman down the way said, he's not returning capital to the shareholders. He's
Mhm.
putting it on top. About the only way you can get return on capital with Berkshire is, selling covered call options, which a lot of people don't like to do. Covered calls meaning, of course, that you
Right.
own the stock. So for a little under $50,000, you can have 100 shares of the B stock, and you can sell a call. What does someone consider to be a reasonable rate of return they're willing to accept? In my case, it's 20% on an annual basis. That's high. So a Berkshire call a year out, January from now, would be $580. And you get about 1%, if it's in a Roth IRA, basically that's a dividend because it's not taxable. And of course, you're looking at a 20% gain and the possibility that if the stock goes to 581, it's going to get called away from you. But that's the only way I can see personally investing in Berkshire, because I don't like owning a stock that's not paying me something to own it.
So let me ask you a question. If going back to 1964, if you had invested in Berkshire Hathaway, do you think you could have generated a bigger increase?
Absolutely not. But there's another thing I think we have to all consider in this room, at least I do. I'm going to be 80 years old in April. So I'm not looking for a 1,000,000% gain. I'm looking for something where, I don't want my great grandchildren to be able to buy a 500-foot yacht, maybe a 54-foot Tiara, but not a 500-foot yacht. I want money that I can use to spend on myself and still have money left over. Dividends, yes.
It's when your grandchildren start asking you for your financial report
They won't be here.
that you have reason to worry. Or like with my son, he says, are you still doing those? Yeah, I'm doing those. I said, can I see it? And, I keep thinking to myself, what does he know that I don't know? But the reality is that those of us in our generation in that, the only way our kids and grandkids are going to have any decent life is based on what they inherit from us. It's going to be really difficult for them to have the same kinds of returns that we've seen over the last 40 years going forward, in my judgment. And so they're going to be heavily dependent on us and what we leave to them as to what their lifestyle is going to be. And you can see it in the numbers. The number of young families that are struggling and so forth because they didn't have the same opportunities. We've lived in an amazing period of time over the last 40 years. As much as we might be concerned about some of the things that have happened, the returns, the equity returns that we've seen have been nothing short of amazing. I'm just not sure that we're going to see that going forward. I'm sorry? No, that's exactly right. That's exactly right. And I'm sure we all remember the mid-70s to the early 80s. It was a pretty rough period. But look at what's transpired since then. I'm just not sure we're going to see the same kinds of returns over the next 15 or 20 years. And that concerns me a little bit of how younger people are going to survive.
What you just said segues very well in my question. Many years ago, Warren Buffett himself said, for the average individual investor, you're probably best off to just get with a few good index funds and don't think for a minute that you can outguess the market. Do you think that's still true in Warren Buffett's mind and your own mind?
I think it
Index
is, I
funds.
think it is true that unless you have the time and the talent to pick out individual companies, it probably doesn't make most sense for people to try to pick out stocks and things of that nature. It's another thing for Warren Buffett and Berkshire Hathaway in terms of having the talent to be able to look at these companies and so forth. And I think that's a reason why we've seen such growth in index funds and things of that nature over the last 10 or 15 years, is people look at this and think, well, I have no clue what to invest in. But I would also argue that those of us who have been in funds or who have invested over the last 20 years have done really well for ourselves. I'm just not sure we're going to be able to generate the same kinds of returns going forward. Most individuals today would argue that the market is overvalued, and anywhere from 15 to 25% based on historical standards. All you have to do is look at PE ratios and things of that nature. We're living in the Gilded Age right now, and that doesn't last forever. Sooner or later, there's going to be a big correction. And the question is, how do you avoid getting wiped out when that happens? And by the way, I don't have a good answer to that.
I have another online question from Mark. He asks, since anyone can invest in Berkshire Hathaway stock, would you feel that would be a good mix with index funds?
Boy, that's a loaded question.
Of course.
You know, again, I would be a little careful about Berkshire Hathaway. I looked at it a while back and, you know, what their composite PE ratio is and so forth. I would definitely say that stock is not cheap. And, but I would say that about just almost about every stock in the market today. When I look at PE ratios that are at levels that blow my mind, when you see things that are trading at a 20, 30, 40 PE ratio, that's discounting those earnings a long ways into the future. Now, I suppose if you can get enough people that will invest in that, maybe you can generate some capital gains. I'm just not comfortable with that. When I look at a company that historically has been at a 15 PE ratio and they're suddenly trading at 30 or 40, there better be an awfully good explanation on why you would invest in that. The other thing I worry about is I think a lot of people don't look at free cash flow in these companies. And that's something you got to look at. Where is that money going? What are they investing in going forward? That's going to help grow that business and that. How many times have people asked that question when they invest in a stock in that? I think it's an important question to address to the company. How are you investing your free cash flow going forward? Some companies are doing it by just buying other companies today, and they're paying significant premiums to get these companies in that. That's not always a very good answer. Maybe it works out. I just think that when you overpay for another company in that, you're just asking for trouble.
During the Great Recession of 2008,
Yeah.
my investments lost roughly 50%. But they essentially recovered to their original value in a little less than a year.
Right.
You have now said you're concerned that that kind of growth may not be true in the future. Why do you believe that's true?
You know, when you look at where the market PE ratio is today compared to where it historically has been, it is very elevated. Everybody's throwing money in the market because they've gotten pretty good returns and so forth. That to me is a warning sign that we're going to have a correction here at some point. Now, I have no idea when that's going to happen, you know, whether it happens the second half of this year or it goes into 2026. But there's a side of me that starts to get very cautious when that PE ratio is so elevated compared to where it has been historically. That means that these companies are going to have to generate extraordinary growth going forward to support those PE ratios. I'm skeptical as to whether or not they can do that. So I'm becoming more and more cautious about throwing a lot of money in the market and because I've seen the other side. I saw what happened in 2008. I saw what happened in the late 1970s. And that makes me a little more cautious. So all I'm saying is people have to make their own decisions about what they're comfortable with. It's hard to invest heavily right now in the fixed income market because of where yields are. You know, if you're going to get a 4.5% yield on a fixed income security, that's not going to get you very far. On the other hand, I'm sorry. Well, that's it. And so what are you going to do? You're going to go out and buy a bond at 4% or 4.5%? You got the inflation rate at 3%. It's not a very good return, to say the least, or your real return is pretty limited. So I personally am getting more cautious about the equity market right now. And I'm worried about what this is going to happen in the second half of the year. That's just me. I could be dead wrong about what's going on in that, but there's a little thing inside of me that says, be careful in here. So.
Okay, I think we're good. No more questions online? Okay. Thank you, Bob, for doing an excellent
Thank you.
job on talking about Warren Buffett. We appreciate it very much.
Thank you. Thank you. Appreciate it. Thank you. Mm. Oh, I forgot to do something. I forgot to tell you that there's a prize being given out. Okay. And you may know that Warren Buffett sells a lunch. So my question to you is, what do you think they paid 2 years ago? Anybody have a guess? To have lunch with Warren Buffett. He discontinued this 2 years ago. Any other guesses? Was Susie, you won. It was 19 million that somebody paid for lunch. And I didn't give her the answer beforehand, by the way. Anyway. What?
A hell of a hamburger.
Yeah. Yeah. Hmm. But he